Hello everybody and welcome back. Well, there are not many times in history where you see a central bank versus the market, but when you do, you need to pay attention. In today's special episode, we'll be taking a look at one of the biggest worrying signs outside of America that's going to potentially cause dramatic ramifications for everyone around the world. We'll also be talking about the gap that's filled now on this SP 500, crypto and commodities, as well as whether we just saw a bit of an island reversal with the gaps down here and a potential for a maybe somewhat fleeting rally. At this stage, most things are still pointing down though, so be careful of the big turnaround areas. We'll be talking about everything in today's video. There's so much to discuss, guys. See you soon. Well, welcome back everybody to the Daily Show where we talk about stocks, commodities, and cryptos every single day here on YouTube. If you like any of those markets, remember to subscribe and of course smash that like button. As we mentioned, it was all green, all good for the Monday, but in aftermarket, we've already started to see some turnaround stories. And this is really causing, of course, a lot of concern amongst traders and investors out there, with many investors saying they're going to sit back and relax, or maybe not relax, but at least wait until the next opportunity arises. And I can see why. There are so many charts for us to discuss today, and they're mostly not necessarily that bullish for at least the medium term. Let's first start by talking about the US federal funds and of course what's gone on with the Fed as we go ahead of Papa Powell coming out and discussing on Wednesday what he thinks about the economy right now. Now, we always know that when the Fed starts to rate hike, they tend to do a really poor job of winding that back. Either we get a recession into the rate hike, as we've seen previously at other times to try to combat inflation, or as they cut the rate hike, we end up going into a recession. Either way, it usually doesn't work out well for the US. It's just the question of when and by how much do we end up falling, and whether we've already packed in so much of this price. The next question becomes, what are the similarities between 2022 and the current crash compared to other times where we've seen similar situations in the market? The 70s and 80s come to mind. In the 1980s, we ended up seeing a turnaround with a nice recovery. And of course, in the 70s, we saw more pain to come. So it comes to the question of how much pain do we usually see? The only way to really figure those types of things out is by looking at the charts and also by looking at the data. And if we bring the data together, it points to an average sell-off of around 3,200 to 3,100 on the S&P 500. At the time of this recording, we're talking about a 36 plus number. So basically, there's still a little bit more to go in terms of if markets get down to here. But as we know, we're traders and investors. So what that means that a trader is going to be looking for rallies, rip rallies, and sell-offs as well as potential turnaround stories. They're not just going to be looking at the downside. An investor might say, I have key levels that I'm looking at. Possibly they follow dollar cost averaging or whatever else other strategy they may be looking at in the markets. So there are other scenarios that seem to kind of fall in line with some of these levels. You'll see here the worst case analysis of the Luthold study highlights, and these big potential downsides found around that 3,200 kind of zone. Notice the TA in this area, very key zone. And also the worst case implied volatility based on the valuations of 1957 and 1995. And that pushes all the way down at current valuations to 2,500. So these are two really interesting scenarios based more on stock valuations and averages. And then of course, if you bring in the technical analysis, we have one at 3,500, one at 3,200, which this comes up with. That other study that found the average is around 3,200, and a lot of points point to here. I've discussed this several times on the channel. I've even mentioned and talked with a few billionaire bond fund managers. I tend to trust the bond managers more than the stock traders, frankly. And those bond managers have all pointed out these types of areas being their base case scenarios later on in the year, if not into 2023. So it's pretty scary stuff out there in the markets. But don't worry, I'm not here to scare everybody across the board. We do still have some shining lights. Obviously, everything can change just like this. If we saw something like China opening up supply, it would drastically change the market. Or, of course, if we saw the Fed come in with the plunge protection team and start buying back and starting QE again, of course, that would turn the markets as well, potentially to the positive side. Here we have the 1 month performance after 2 weeks of strong declines. Obviously, we've had 2 weeks of 5% plus declines. This doesn't happen very often, but when it has happened, we tend to get a little bit of relief rally, which is what we've been semi-angling for here in the markets for now. The question is whether it's relief that then becomes bearish, e.g. the 87 and 74 scenarios, or whether it's a relief that only lasts a few weeks and then turns into something much, much worse. We'll end up talking about that in today's video. So this brings us to the discussion that we need to talk about, which is, of course, the Japanese central bank. And this is where things get a little bit scary. We haven't seen central banks intervening to try to peg something for quite some time. I remember the Swiss central bank pegging back in the mid 2010s and what that ended up doing. And let's just say when we look at the scenario a little bit later, it wasn't pretty what happened when they let that go. But the Japanese central bank, and the reason we have to talk about it now, intervened in a massive way in the last 24 hours. They have to push and they're trying to defend the rate sitting around 0.25. Basically, they are going with monetary still stimulus versus monetary tightening that every other country around the world is doing. This is not good because, as you can see, plenty of times it's breached, but this was the biggest breach that we've seen. And the amount of trillions of yen that it takes to stop these types of attacks on the yen is incredible. And this is, of course, the 10-year yield pushing out very, very high here. We will be going in more depth in another video later on this week, so make sure to subscribe as we cover off on the yen and the Japanese central bank debt crisis, because these guys are well known to not only buy their own equities in extreme form, but also to buy their own bonds. And at some stages, they own 50% plus of their entire bond market. I mean, think about how ridiculous that is. 50% plus of their entire bond debt they own themselves, which is just almost doesn't make any sense. Let's go over to the US dollar again. Most of you have been following this if you've been looking at currency. We saw it all happen in March, and this was the first defense. Notice here, we have these movements through and we start putting pressure on the pegged level. We start breaching the pegged level and the central bank comes in and says, no, we will not allow you to do this. We will not allow you to push it through. We will just completely destroy our currency to get it there. And that's what's occurred since that point. As the pressure goes on, so does the yen in terms of devaluing. So this is the US dollar versus the yen. So remember, the yen is actually weakening heavily here. As it goes higher, the easiest way I can explain this is basically if you have like a trade that you start doubling down on. We've all been there. We've all had that kind of bad trade. Usually people do it when they first begin. They kind of say, okay, I'm going to dollar cost average in on this, or I'm going to buy a little bit here and then I'll buy a little bit here, and you get more and more convinced that it's going to be okay. And then unfortunately you run out of money and it all explodes. And of course, how hard is it to get that back? Think of this on a giant scale. That is what the Japanese central bank is currently doing. And as this pushes up, and the further this pushes up, the more concerned you have to be about this effectively blowing and then sending ripple shockwaves through all of the economies around the world. And in some ways, it may end up doing the Fed's job because these don't tend to end very well. Let's just have a look here at the euro versus the CHF. So this is one that was pegged in the past, and I still remember this day incredibly well. And believe me, what's printed on this chart is not the reality of the situation. It actually went down into the 40s in terms of the cents. So it went all the way from the 1-2 peg all the way down. Now, it's a slightly different situation, but this is what happens when central banks intervene. They couldn't hold it. They tried to hold it, but notice the difference. We are coming in at a point where they were defending, and it was costing them billions a day to defend this wall. They basically held it here and they held it here. They let the pressure was too much for them and they had to let it go, and it sent illiquidity across the board. And I know some people that got absolutely destroyed during this particular time because they didn't know that they were trading in a market where it was central bank versus the big guys, and they were fighting each other in terms of a very, very serious thing. So guys, I know we spent a bit of time on it today, but I just want you to know that This is seriously a big issue in the markets, and I think that at some point this could have dramatic ramifications across. And again, a special video coming soon about all the intricacies of that. Let's get back into the normal markets though. We'll talk about the VIX here straight away. Volatility S&P 500. Yes, it dropped, technically good, still above 30 though, not much to report there. Still a very volatile market with, of course, incredible swings coming through. Then we have the US 2-year versus 10-year, still very close to inversion, basically inverting. This is, again, not good for the markets and still having such a high rate. We want to see these US 2-year rates go down. And at this stage, they haven't even made a new low. Look for a 3.08 or something like that to force us into those lower kind of points. US 10-year, we want it to get below 3.18. Remember, yes, oil is dropping. Yes, some of these things are starting to turn around, and oil's getting crushed at the time of the recording of this video, which we definitely suspected would occur. And that might be good on the long term, or at least better, but there are reasons why they are dropping as well. And that's a lot to do with this risk that comes across in terms of what Dr. Copper's telling us as well. And of course, the growth and economic slowdowns around the world. US dollar is still struggling in terms of being able to fall over. We thought in the previous session that this might be a good signal towards the negative side. It dropped through and instantly rebounded, putting pressure on the upside. I'd say the DXY is hard to read at the moment. I'm still looking towards that down, but as long as this US central bank, the Japanese central bank continues to fight with the market and continues to try to pressure that downside, I don't know whether the DXY can really fall that much while this fight is going on, because it's a serious real deal there. Let's move over to gold. Gold coming under some pressure. It fell through the area that we were talking about in the previous session, got a new low. Next stop probably for gold, maybe down near this 1817, 1820 area, a previous defended area, and it must kind of try to find some buying pressure here. We're looking for turnaround stories inside of this box, and that would be the best case scenario. Obviously, what you're doing at the same time is if there's a turnaround here, you're looking for the US dollar to also decline at the same time, allowing for gold to turn to the upside. Speaking of oil, another big drop off here. We did a great stream on it. I thought it was a pretty good, great stream on Tuesday on the open. It was fantastic to have thousands of you there, so really appreciate that. But it was a great day for trading if you were in for the gap trade. We also talked about oil and the distribution pattern on it, and it actually happened exactly as we discussed, which was the slight false break to the upside. We've all seen this one before. The distribution, effectively that kind of Wyckoffing distribution, and then the breakdown. And this is sending mass shorts coming into the oil market. There's a potential here that oil will even fall as low as $98. And I guess it's good to see, well, hopefully you're not too long in it, but it's good to see this stuff starting to occur. Really for us, it all happened here. This was big shorting, of course, the distribution. And at this stage, it does seem to be weakening off. Of course, it's hit the first little level of demand, so there may be some buying first, but there could be a real side here to push oil down, which is theoretically good, at least for the American consumer and all of us out there that wants to buy fuel for our cars. Let's move over to Tesla, speaking of fuel, and it was a good session, really good session. We moved into the 700. We actually breached above the 700, which is a fairly big deal. So we managed to get above that, basically putting in a double bottom pattern. And a lot of the market actually started to look like it wanted to recover. And while the futures market is quite red, things can turn around. There are real concerns here from the Japanese central bank. And I know that I'm probably coming in here with a massive bearish bias on that. But that fight, I don't like it. And I'm just going to speak from some experience here in over 10 years plus, 14 years in these markets. I've seen it before. And I haven't seen the ones that many people have told me about back in the 90s. And obviously I wasn't in the market at that time, just too young for it. But it's very important that you study those kind of things in history, because generally they don't work out well. And if they don't, I want to know what you guys think about it in the comments down below. Do you think it's going to work out well? Because when central banks fight with the market and don't go with the market flow or control it themselves, you start to think, whoa, how bad is this going to be? Because it has dramatic ramifications. It might actually end up doing the Fed's job for them by seeing another economy really struggling, but it's not necessarily a good, at least initial shockwave that can go through these markets. Let's look at Tesla. We've got the double bottom. We've obviously got the movement here in terms of maybe a slight ability for the market to hold up. It was a good breakout, but it's not enough just yet. And what I mean by that is if you bring in things like little trend lines here, you'll notice that's where it hit. It hit right into there and then sold off. So once we go into the actual indices, you'll start to see what I'm talking about. Here's the Russell. The Russell had a decent pickup, but it hasn't gotten through this box zone. For the market to turn around, we need more than just a little 15-minute, 5-minute, 30-minute turnaround. We want to see a lot of time frames breaking through supply levels, which are here, and actually showing us that the market is ready to go and fill the gaps that were left on the left-hand side on the way down. At this stage, we haven't seen that, at least on something like the Russell. So stay tuned for that. US 30, the Dow, let's have a look at that. Down here, you can see coming back to a critical point. Previous demand, supply, a critical level here for the Dow at the time of recording. Will we turn in this area? Most bulls will have to hope so, because this is going to be a very pivotal point to get that market, of course, towards the next level. Again, similar to IWM, they're all setting up the same. We need the market to breach these zones so that we can go and fill the gaps that are left on the left-hand side and show us the turnaround story. At the moment, we're on very small time frame turnarounds. That's how we made the predictions for Monday, of course, together as a community. We made those based on puny time frames, like less than 1 hour, 15-minute, 30-minute. That's not a big one. We want a big one. I want to see 4-hour, 2-hour, 3-hour daily turnarounds. And that doesn't really happen until we get above that type of structure from the first time frame. Nasdaq, very similar, was strong for the session. It actually did really well. It's come up a lot more, but still very weak here in terms of the way that it's looking in this futures market. We kind of need turnaround somewhere in this area. Ideally, when the US market opens, there will be a gap to the downside, which is okay. I know I say ideally because there's a chance that you get structure, and then if you get structure, it can come back up and at least fill that gap. Maybe bears come back in there. The bulls and the bears will really fight it out, though, around this 11,750 zone for the Nasdaq, which was the FOMC highs. So we're coming into a day of Papa Powell telling us what he thinks about the US. Will he say, oh, hey, guys, I think we're in a recession. Maybe inflation wasn't transitory. Now it's recession. Well, I lied to you 2 months about that. Maybe that's what he wants to say. I don't know. But whatever he says, he usually likes shocking the market, and then often the market will pick up after his discussion. We'll have to find whether that holds true. Let's move over to the way we had it priced into, these are the boxes, I haven't done any changes to them, into the actual market itself. This was taken from the live stream in the previous session. We had, of course, the lows here. We know what they are. We had that critical level that we wanted to see breached, which we did see breached. And we had the great session that filled the gap, or at least the box zone. You can see it just hit into that 37.8 area. And then since then, it's sold off. Again, critical area at the moment, as of the time of this recording. Anywhere in this box zone is where you want to see that SPY turnaround. If it's to go long, and where do we really want it to breach? 38.20, 38.30. If it can get through there, at what point do we like it? More so at that point, because then we can go on to fill the gaps that sit in these markets. And we have basically the left shoulder, the head, and potentially the right shoulder at that point as well. This is kind of how these patterns form. Everything looks kind of scary. There's still a chance here for recovery, but you're going to have to start watching that Japanese yen situation in the central bank, because it's becoming dire, and that's why we have to report on it today. So sometimes there are island reversals in markets. They're pretty rare, and basically where it is, it's a gap that goes down, a bit of a stabilization, and then a gap that goes up. From a technical pattern, these tend to happen more in stocks than indices, and they tend actually to be a bullish style pattern. So even with the pullback here, islands can often be saved by actually recoveries. And it's an interesting one, because the island is here. Obviously, we had the huge volume thanks to the quadruple witching event. But what do you guys think? Do you think this will breach through and go on to fill these gaps? That's certainly the scenario, or a few of the scenarios that people are coming up with. And it's an interesting one, because it's, really an island, a slightly bullish pattern, but still not breached past this area. That's going to be big for the big day traders. Let's have a look at what's happening with the options for the week. Friday expiry. a pretty surprising amount of calls that are sitting on open interest here around 380. So again, we got close to that level. Look at these options all sitting around 380. Current max pain, 378. 380 being just a huge amount of calls. Probably worthwhile watching those to see if they remain open throughout the week. Maybe that is a little bit of a too hard to get through for the market for now, and we still see stabilization, but we'll watch that as it occurs. Bitcoin, nothing much really to report here. Bitcoin's doing its own kind of thing with the rest of the market. If the Nasdaq goes up, expect Bitcoin to do better. From a daily closure, pretty bad looking candle, obviously a shooting star coming from a long leg doji. It's the kind of thing that you might say, well, maybe it's turning around. But with Bitcoin, it hasn't got through our key box level here. So 23,024 in that range is where we think the market is really recovering. At this point, it's all just more speculation of these lows. And that speculation can be justified in some ways, of course, based on production cost. We've shown this chart before. We're still right on basically what it costs in pure electricity charge to mine a Bitcoin. So without even buying the actual computer parts, which is the total cost, this is how much it would cost to mine a Bitcoin. And right now you're looking at break even just on the electricity. So this is usually getting close to the lows for these types of markets, but Bitcoin, as we know, is a risk on asset. And at this point, the stock market is freaking out. I believe a little bit to do with the Japanese yen and the central banks. It's been there for a while, but that intervention was huge. I mean, that would have cost trillions of yens to pump back down. If you haven't already, please follow us over on, of course, Twitter at FX Evolution is our handle. And remember, there is a whole bunch of information coming out from Fed. The Papa Powell, he's coming out Wednesday, 9:30 a.m. around the market open. He'll testify. And then we scroll down. We've also got him coming out Thursday at 10 a.m. So plenty of information coming out from Powell. Watch that Japanese yen and, of course, the yields there, especially the yield, seeing how they hold that down. If that gets broken and breached, it could have dramatic ramifications around the world. So be careful out there, guys. Stay safe and, of course, be nimble and quick in the markets right now. This is the year of the trader and, of course, the year of the investor that's picking their correct levels. So good luck out. Subscribe, smash that like button. We'll see you in the next one. Bye for now.